Finding and attracting investors. An introduction to finding the right investors and an introduction to how investors affect your business. The course has 4 key objectives. Explain why a small business may need outside financing. Identify 3 types of investors and their investment requirements. List 3 benefits of securing capital from an investor. List the typical steps in the process of finding investors. This course will cover 5 topics. These topics will illustrate how locating and attracting investors can improve your business success. When is outside financing necessary? What is an investor? Where can you find investors? What is the investment process? What are investor expectations? Let's get started. Finding and securing investors can be challenging. Let's explore the issues facing a small business when deciding to expand the use of investors. The focus of this course is to help the small business owner decide if bringing in partners or outside investors is the best option for their business, to give the small business owner methods to incorporate partners or outside investors, and to list some of the potential complications that can occur when taking on partners or outside investors. When is outside financing necessary? If you want to expand your business, you will have to decide if you can do so with your operations cash flow or if you will need outside financing of some kind. When starting a business, you will have to decide if you need outside financing as startup capital. Reflect for a moment and consider whether you need outside financing. There are traditional sources of financing, including banks and commercial loan companies, that are debt-oriented. There are other financing options involving investors. These include factoring, venture capital firms, individuals, and business acquaintances. In addition, there are non-traditional sources like crowdfunding. If you choose to pursue outside financing, you will need to decide whether you want to acquire it through equity or debt. You can take out a traditional loan from a bank to fund your expansion or startup costs. This allows you to maintain full ownership of your company, but the additional capital is listed as a liability on your balance sheet. You can also sell equity in your company. Selling equity can be difficult, but there are significant advantages to equity financing. You will not have a repayment burden on your cash flow from operations. On your balance sheet, capital is listed under stockholders' equity rather than liabilities. Also, professional investors, such as venture capital firms, can bring substantial expertise to help your business succeed. Of course, there are some significant disadvantages depending upon your point of view. Advice from investors can be seen as interference. Once you or your company accepts money from investors, you must run the business for the good of all stockholders. Professional investors will require audited financial statements and independent accountants. Finally, professional investors will require a voice on the board of directors. Reflect for a moment. Would you prefer to take on debt to expand or start your business, or would you prefer to sell equity in your company? Carefully consider the pros and cons of each before deciding. Equity comes in several forms. You can sell common stock, which gives an ownership interest and right to vote to your investor. You can also sell preferred stock, which gives the investor an interest in assets and revenues. However, there are hybrid options as well. You can sell convertible preferred stock or get convertible debt, which can convert to common stock in the future. Now that you have decided you need equity, let's discuss who investors are and what they expect from you. An investor is someone who places money into a business, usually receiving an ownership or partner stake in the business. Since the investors undertake a great risk, they may require a substantial share of ownership in the business in return. It's important to remember that investors do not place debt capital in your business. Investment is not a loan. Investors can also contribute to the credibility of a startup or growing business through their scrutiny, certification, and investment. There are several different types of investors and methods of investment, such as equity financing. Equity financing is based on the company selling part of its ownership to other investors, either private investors or to the public. In its simplest form, the owner of a company decides to raise some additional capital by selling shares of stock to family members, business acquaintances, or key employees. Another option is a formal private placement of securities to angel investors. Angel investors are generally wealthy individuals who invest in early-stage companies or mature companies wishing to expand, with the hope of earning a substantial return on their investment. A third option is venture capital firms. A venture capital firm is one that provides funds to early-stage, high-risk, high-potential startup companies. Venture capital firms recoup their investments by owning equity in the company in which they invest. Venture capitalists have more requirements and usually involve funding at a much higher level than most angel investors. Almost all venture capitalists will require a seat on your board in return for their investment. A final option is casual or non-professional investors, such as friends and family who are interested in helping your business succeed. There are many places where you can find potential investors. Your local community is one of the best places to start your search. You can also look at business and trade organizations, which are optimal places for networking. Your local Chamber of Commerce can provide resources. You can call the Small Business Development Center in your area for information about local investors. Visit www.sba.gov/local-assistance to find your local SBDC. A final option is regional and state economic development agencies, which help new and established businesses start, grow, and succeed. Visit www.sba.gov/content/economic-development-agencies to learn more. Where will you begin your search for investors? You found a potential investor. Now, how do you convince them to invest in your business? The main strategy is to sell, sell, and sell. You have to give the potential investor a reason to invest in your business. You can fine-tune your pitch based on what the potential investor's needs are. Sell your business plan. After you convince your potential investors to hear you out, you must prove that your business plan is strong and convincing. Make sure you have a detailed and well-written business plan to show you have done your homework. Include financials and market research. Show them the money. Detail how your business will generate profit and how that profit ends up in their pockets. Ultimately, all investors want a solid return on their investment. Reflect for a moment. Are you really prepared to approach an investor? Due diligence and preparation are equally important for all investors. You should go through the same preparation process for a venture capitalist or a family member. To evaluate an investment in your company, investors want a business plan, 5-year financial projections, current audited financials if available, a reason to invest in you. What is the return on investment? Once an investor is satisfied that the investment works from a financial point of view, the investor takes a very close look at the management team. A company must expect that any deal with angel investors or venture capitalists will be heavily negotiated. The company's leverage depends on its need for the investment and the tolerance of the owner for oversight by the investors. Investment from family and friends typically does not require the same level of negotiation. A recently emerging source of investment is crowdfunding or crowdsourcing. You can sell up to $1 million of securities a year without doing a public offering. How does it work? A crowd of people, each of whom takes a small stake in a business idea, contributes toward an online funding target. Advantages: raising your own capital, creating a strong network of support for your business, providing a newsworthy backstory. Disadvantages: full rules and regulations regarding crowdfunding are not complete. You must use a pre-existing crowdfunding portal or gain approval from the Securities and Exchange Commission, or SEC, to set up your own. You may need legal counsel to assist with the legal forms. Would crowdsourcing be a good approach for you? Securing investments from friends and family can take up to 30 days. Figure at least 6 months to find and secure capital from angel investors. The process of securing investment capital from a venture capitalist can take up to 8 months. What is your expansion timeline? What is expected after investment capital has been secured? Professional investors, those who are not family or friends, usually have specific expectations as to investment returns. Angel investors have differing expectations, but will require substantial profits. Most venture capital firms expect a 50% per year return on their investment, and the financial projections you provide must support that kind of return. All professional investors need an exit strategy. The investor must know when and how the company proposes to make his or her investment liquid. That was a lot of information about some relatively complex concepts. Let's review. A small business may need outside financing when it is not possible to expand based on operations cash flow alone. Startup businesses may need outside financing to fund their startup costs. Outside financing can come in the form of a traditional debt or through investors. We discussed 3 types of investors: angel investors, venture capital investors, and non-professional investors. Each investor will likely require some kind of return on investment in the form of an ownership stake or monetary compensation. There are a lot of benefits that come with securing outside investors, including an infusion of capital for growth, managerial and technical expertise, and potential business connections and collaborations. Securing an investor usually requires the development of a business plan, 5-year financial projections, audited financials if they're available, and a solid reason to invest in your business. Now, what should you do? Follow these steps to begin expanding your business. Step 1. Discuss with a mentor, coach, or SCORE or SBA representative to determine whether your business is ready for outside investors. Step 2. Create a business plan that includes a sound financial statement using SBA resources available to you. Step 3. Identify and solicit investors using the techniques you learned from this course and your mentor. Step 4. Consult with your mentor or coach as you negotiate the terms of your investment. Step 5. Execute the exit strategy agreed upon during negotiation and enjoy the success of a profitable investment that leads to the growth of your business.